Hello everyone, this is Rohit Khemchandani and today we are going to discuss a very interesting and highly discussed topic which is behavioral finance. So in this course, we are going to understand the basics of behavioral finance, basics uh, in the biases which are involved in the decision making process, behavioral finance in the field of stock market, and the theories which are related to it. So we'll going to discuss all these things. Firstly, I'll give you a gist of this topic, and after that we'll go into a deep version of this behavioral finance topic. So basically, this topic is crucial, or this should be understood by all the undergraduate and graduate school students, mainly who are in the field of finance or corporate finance field. So it is more inclined towards their objectives. And not only it's related to or only limited to those students or people. It's a very common topic, and it's mainly used in the field of stock market. So how we take decisions in the stock market, it also affects that philosophy. So we are going to discuss this topic in detail. So traditional economic theories assume that people act rationally when making financial decisions. So generally we think that the basic economic theory suggests that generally people act rationally. They go by the usage of data only to take the financial decisions. So how this topic emerged basically, and what is this actual topic? So what is behavioral finance? This is our first main question, which needs to be answered. So it's an economic theory that explains often irrational financial behavior, such as overspending on credit cards or panic selling during a market downturn. People often make financial decisions based on emotions rather than rationality. So suppose if I'm a new investor, I don't know about the basics as of now. So suppose the market is going down and I am thinking that I have suppose 10 stocks of 100 rupees and the stock is daily going down. So I'll just rather without having much knowledge about why it's going down, what are the factors, can it go up in the future, should I hold my position? So I just start selling without thinking so much. So I just take decision on my emotions. So behavioral finance uses financial psychology to analyze investors' actions. According to behavioral finance, investors are not rational. Instead, they have cognitive biases and limited self-control that cause errors in judgment. Because there can be a case that the stock market is this downward movement is for a short term only. The stock market can go up in a future time also. So the decisions are limited are because of the cognitive biases and limited self-control, which have caused the errors in the judgment of that individual. So this is a very small gist which I just wanted to provide in the initial, that what is behavioral finance? Basically, financing decisions which are affected because of the behavior or the emotions. So that thing I'll explain in detail in the later slides, that what's actually we'll discuss some of the basic definitions which have been come up from a period of time also. So we'll discuss those also. So the start with the basic agenda. So we'll discuss what is behavioral finance, what is the history. So we'll discuss few of the standard definitions, then how the definitions evolved over the period of time. Understanding behavioral finance, we'll understand what is behavioral finance. We'll understand the concepts. We'll understand and we'll discuss the biases which are revealed by behavioral finance, how it plays a role in stock market. We'll understand two type of biases in detail. One is cognitive biases and other is emotional biases. And also, we'll wrap up our discussion by understanding behavioral finance in corporate finance. And lastly, we'll discuss the conclusion. So, starting with the history of behavioral finance, it dates to 1912 when Psychology of the Stock Market was published by George Selden. So, the concept of behavioral finance dates to 1912 when George Sheldon published his book Psychology of the Stock Market. However, the theory gained popularity and momentum in 1979 when Daniel Kahneman and Amos Tversky proposed that most investors tend to make decisions based on subjective reference points rather than objectively choosing the best option. So it depends on the sentiments which they have set, that it's the sentiments which play a role in taking financial decisions. If the market is going down, many people are selling their stocks. So there will be a herding effect. And ultimately, I will also end up selling a stock. Rather than rationally waiting, understanding what is the market pattern, why it is going down, is there any possibility that in coming future the market can go up? So we shouldn't sell our stocks or our things or our commodities just because of the market pressure, because of the herding effect. So they basically propose that the investors tend to make the decisions based on subjective reference points rather than objectively choosing the best option. A year later, Richard Thaler introduced the notion of mental accounting, which is the idea that people view their money differently based on its function, such as whether it's for retirement or for a college fund. Eventually, their work became the basis for the study of cognitive psychology and behavioral biases in finance, which features prominently in the field of behavioral finance. Now, according to behavioral finance theory, there are several types of cognitive biases that can affect an investor's judgment. So we'll discuss the cognitive and emotional biases later in detail in this course. I'll just give you a gist. So overconfidence is one of the cognitive bias. So I'll quickly help you with this, that most people tend to overestimate their abilities in many areas. So for example, suppose there are 85% of Americans think their intelligence is maybe above average, and around 75% think that they are better than the average driver. So when we overestimate how much we know about the market or a specific stock or commodity or whatever, we'll be tempted to make risky decisions, just like trying to time in the market, while which is trying to predict the best time to buy and sell stocks, or over investing in high risk stocks, so which are more likely to lose money. So basically we overestimate how much we know about the market or a specific stock. So rather than doing the things uh, by knowing the data, by having the knowledge, we overestimate sometimes, and this is the reason of our overconfidence. Herd mentality. So just like humans are also social animals. So as suppose 10 people are buying a stock, if I'm a new in the stock market, I'll ask them that what is the best stock in this thing. It's the herd mentality sort of thing. So I am saying this is the best stock, then it will be a word of mouth. Someone else will hear my thing. They will again say that this is the best stock. Now, if 10 people or hundreds of people are saying that this is the best stock, as some random new person will heard this that will heard about that stock, and then they or he or she will also end up buying the stock. So it will be a herd mentality. So going along with the crowd is in our nature. We just go with the crowd. From the hot new fashion trend, everyone is wearing to the crowded restaurant that requires you to make reservations months in advance. People tend to make choices based on what others are doing. We basically say that what is my neighbors doing? I just every time compare me versus my neighbor or some other people. So we are just trying to follow what others are doing. In many of the situations, herd mentality is appropriate and benign. The only lasting harm is old pictures your maybe children will mock after a few years. In financial markets, if I say, however, herd mentality can lead to asset bubbles, which is when the price of an asset like a stock rises rapidly, but will eventually fall. The market crashes and occur when a lot of investors sell their stock. The other bias is loss aversion bias. People feel the pain of loss more acutely than the euphoria of a win, even if they win more than they lose. In financial terms, investors will often hold on to stocks they should sell to avoid realizing a loss. Conversely, they may sell too early to avoid further losses. When waiting for a market rebound would be the better option. Often, investors with a strong loss aversion bias have portfolios that are too conservative, underperforming, and market norms. So, I'm trying to restrict myself from getting a loss. I'm just holding on to my stock for a period of time. So I'm a bit worried about my loss. So this is the loss aversion bias. Confirmation bias. So confirmation bias explains how two people with opposing viewpoints can hear the same information, and each comes away believing it supports their opinion. When you have a held belief, you give heavier weight to evidence supporting your belief while minimizing evidence contradicting it. So if there is a point which comes to me that this is the situation, if I have a preset mindset, then I'll work in that direction only. So when you have a firmly held belief, my belief is already strong. I'm already inclined towards one decision. So I'll give the heavier weight to the evidence supporting my belief while minimizing the evidence which contradicts it. In finance, confirmation bias can also lead you to overlook investment strategies or assets that fall outside of your bubble. So I've created a bubble. I have a myopic vision. So this confirmation bias will not allow me to look out of the box, to take some decisions which are not easily seen to me, because already I have a confirmation bias. My bubble is strong. I have a already pre-decided belief, which ultimately leads to ultimately leads me to miss the significant growth opportunities. I may invest too heavily in one area because I haven't really analyzed the risks which are there. So maybe some other thing has lesser risk, but it can give me high results. But I'm not looking towards that because already my mindset is set and I'm inclined to one direction. Now we'll see that few of the definitions which have come across in the field of behavioral finance over the period of time. So we'll start with one more definition. So behavioral finance, as I already discussed, with its roots in the psychological study of human decision making. It is a relatively new and evolving subject in the field of finance. So in brief, I'll tell you that behavioral finance is the study of investor psychology while making investment decisions. Being a relatively new subject, not much research literature is as of now which is there. So it's a evolving topic. There are many researches which are going on this topic. So it's a developing topic which is we are discussing today. However, few of the researches has revealed that psychological biases such as emotions, fear, overconfidence, greed, and risk aversion influence investors' behavior that in turn influences stock market. So we'll discuss this behavioral finance and stock market in a bit detail later on. As such, there is a need for studying and understanding behavioral finance to exploit investor psychology for profits. So behavioral finance is the study of investor psychology while making investment or financial decisions. Now, we'll discuss few of the definitions. So Lintner G and Olsen R. So Lintner G 1998 defined behavioral finance as being study of human interprets and acts on information to make informed investment decisions. So he said that behavioral finance as the study of human interpret. So I've interpreted something and this and my acts which are on those information to make the informed investment decisions. While Mr. Olsen R in 1998 asserts that the behavioral finance seeks to understand and predict systematic financial market implications of psychological decision process. So the implication of my psychological decision process uh, will ultimately help me predict the systematic financial market implications. Whether in the next year, which is in 1999, Schreifrin explained that behavioral finance is rapidly growing area that deals with the influence of psychology on the behavior of financial practitioner. So what role psychology plays on an investor's mindset? This thing is explained by behavioral finance. In 2009, W. Forbes defined behavioral finance as a science regarding how psychology influences financial market. This view emphasizes that the individuals are affected by psychological factors like cognitive biases in their decision making rather than rational and wealth maximizing. So he suggests that it is not the rational or wealth maximizing things which my decisions are dependent on. It is more dependent on the cognitive biases which affects my decision making in the investment market. Earlier to this definition, Mr. Swill in 2007 and Mr. Schneider in 2007. So Mr. Swill stated that the behavioral finance challenges the theory of market efficiency by providing insights into why and how market can be inefficient due to irrationality in human behavior. While Mr. Schneider gave certain examples while defining behavioral finance, so basically, he said that uh, investors biases when making a decision and thus letting their choices to be influenced by optimism, overconfidence, and conservatism. So, being conservative, being too optimist, and overconfident, these things um, influences my decision making process. While experience and heuristics help in making complex decisions, the mind processes available information, matching it with the decisions maker own frame of reference. So I've already created my bubble. My mindset is already set, thus letting the framing by the decision the maker impact the decision. So I have already pre-defined mindset, and according to that mindset only, I'm going to uh, take my decision in whatever financial decision I'm taking. So behavioral finance is defined as the field of finance that proposes psychological based theories to explain stock market anomalies. Within behavioral finance, it is assumed that the information structure and the characteristics of market participants systematically influence individuals' investment decisions as well as market outcomes. Now we'll discuss what is the meaning of behavioral finance in detail. So behavioral finance is the study of influence of psychology on the behavior of financial practitioners and the subsequent effect on market. According to behavioral finance, investors' market behavior derives from psychological principles of decision making to explain why people buy or sell a stock. Behavioral finance focuses upon how investor interprets and acts on information to take various investment decisions. In addition, behavioral finance also places emphasis on investors' behavior leading to various market anomalies. It is the study of investor psychology while making financial decisions. Investors fall prey to their own and sometimes others' mistakes due to the emotions and financial decision making. So I've already uh, hinted you regarding the herd mentality. So if someone is also making a mistake, I may also follow the same path and ultimately end up making a loss or making a profit, which depends. So for many financial advisors, behavioral finance is still unfamiliar and it is unused subject. There are some financial advisors, however, who have taken the time to read and learn about behavioral finance and use it in practice with good results. These advisors realize that being successful is just as much about building great relationships with client as it is about delivering investment performance. And they have also observed that behavioral finance can provide tools that can help them get inside the head of their clients in order to build mutually beneficial relationship. So by the use of behavioral finance, provides me the tool that it helps me to get inside the head of the client in order to build mutually beneficial relationships. So understanding how clients actually think and behave is a key ingredient in the recipe for success in acquiring and retaining clients. So suppose if I have to retain clients, I have to be in their boots, realize what is going in the mind of that particular client. And if my frequency is matching with their frequency, then it is a very great opportunity to either retain that client, or if I'm talking about to building a new relationship. So behavioral finance also provide me tools that can help me get inside the head of the client in order to build mutually beneficial relationship. Hence, it is a very powerful force in the financial advisory field. It tries to understand how people forget fundamentals and take investment decisions based on emotions. For decades, and economists have argued about the rational behavior of investors. Now, psychologists are coming in and they are finding that human beings often do not act that way. So, psychologists are suggesting that the decisions are more based on their emotions and psychology rather than on rational decisions. Psychology has a story to tell about investing, and it is different from the one economics tell. It is the study of the influence of psychology on the behavior of financial practitioners and subsequent effect on the markets. Research in this area is already emerging, which we have discussed. It's an ongoing topic. So, for example, people use just past performance on the best predictor for future performance and often invest in mutual funds or some stocks with the best 5-year track record. So many a time it happens that we are just going by the emotions. Suppose if I take the example of some mutual fund. So I just see that which, suppose there are three types of mutual fund in this market. One is large cap, mid cap, and small cap. Suppose five of my friends are saying that we should invest in small cap funds. Okay, with the herd mentality, I'll just quickly agree. Okay, let's invest in the small cap funds. Now there are 10 different type of small cap funds. How we are going to say it? In which fund finally we should invest? So again, we'll discuss with one or two people. They'll say that this fund is better, this fund is better, this fund is better. But every time, if there is a rational decision which we have to take, then we'll analyze those 10 different funds. We'll see in what different categories of stocks they are invested in, they are trying to invest in. What is the performance of those top 10 or top 5 top performing stocks in that particular mutual fund? And again, we are going to take the informed decisions. But what we actually do, we ask, firstly, we, because of the herd mentality, we say that okay, this we'll invest in small cap fund. Then out of 10 different small cap funds, we finalize 2 small cap funds based on the again recommendation. Then we'll just see their last 3 or 5 years of performance, and based on that small data set, we are going to take a decision that this XYZ we are going in this XYZ fund we are going to finally invest our money in. So this is more dependent on our emotions and psychology rather than getting the rational decision. or finally finding out that which actually stocks are related to that particular mutual fund, what is their past performance, what if I invest this, what is, suppose the particular fund is having the top 10 banking stocks, suppose, and in future there is a rise in repo rate or some issues are going with seen in the market, of market are predicting, but we are not seeing doing that type of research. We are just taking the decisions based on our emotions. Now we'll discuss how behavioral finance developed. So the rationality of traditional finance is questionable because traditional finance theories cannot give a proper explanation for it. The traditional finance theories are based on certain assumptions. These are: investors are rational, the market is efficient, investors form their portfolio based on the mean variance rule, and the expected return are the function of the risk. While behavioral finance criticize each and every of this assumption. So there were few assumptions which were initially taken by the traditional finance theory. Firstly, it is the investors are rational. Second, the market is efficient. Investors form their portfolio based on the mean variance rule, and expected return are the function of the risk. But behavioral finance has criticized each of these four theories, and every assumption saying that investors are normal and irrational, the market is not efficient, investors do not construct their portfolio on the mean variance thing, and risk is not the function of expected return. In 1980s, behavioral finance developed by different researchers and different fields of combining together like economics, sociology, psychology, and engineering. So everything combined, and it is still in the developing stage. So it has attracted interdisciplinary researchers. So many researchers from different field have come up. They have talked about this topic from various fields like economics, sociology, psychology. They have all come up, they have provided their inputs, and still this field is is rising. Now this field is, we are just continuing this thing. So biases and psychological influences affects the financial behavior of investors and financial practitioners. These biases and influences can be the cause of various market fluctuations and anomalies, especially stock market. So basically, behavioral finance is the area of study that focuses on how psychological behavior influences financial outcomes. We can see in this point number 4 that sociology, psychology, and finance, these all are interrelated, which goes to explain the behavioral finance. At the same time, we also see that economics, if combined with psychology, can give us the result of the behavioral finance. So the this is basically a cycle which I have explained: this sociology, psychology, and finance. So this basic cycle ends up in the behavioral finance. The credence of the new dimension of behavioral finance is being defined as the application of psychology to finance. The evolution of this proliferated section explains the way of thinking process of investors, counting with the normal emotional cycle which actually intervene in the decision-making process. So behavioral finance is being built on the basic tilt of understanding of fields like psychology, sociology, and finance. Everything is interrelated. Everything is helping each other to finally comes out with the outcome of which we call as behavioral finance. Now we have already discussed the theories, so just giving a gist of it again. So in 1955, Herbert Simon theory was models of bounded rationality. Then Festinger 1956 gave us the theory of cognitive dissonance. Tversky and Kahneman in 73-74 introduced heuristic biases, which we'll discuss in the later slides: availability, representatives, and anchoring and adjustment. So this was the time that this topic just gained popularity. In 1979, the prospect theory introduced loss aversion bias. Again in 1981 by again Kahneman, framing bias was introduced. Richard Thaler in 1985 came up with the accounting bias. Then in 1985, again, there was a theory of overreaction in the stock markets. Then in 1999, Meyer statement came up with behavioral asset pricing theory and behavioral portfolio theory. So we are not going to discuss all these theories in detail. I am just naming few of the theories which, if you want to learn in detail, you can just research on Google and you will find plenty of data to know about these theories. But we just wanted to say is that from 1955 and maybe earlier than that till today, this topic is getting lot of researchers are getting involved in it. New theories are coming up over the period of time, and this topic is totally under development. Um, Now, as I have said, that economics and psychology, they if they combine, that behavioral finance is formed because of that. So when psychology has an influence of economics, so behavioral finance is the outcome of that. Now we'll discuss few characteristics of behavioral finance. So firstly, there will be four key things, four key characteristics of behavioral finance. First, heuristics, framing, emotions, and market impact. These are the four main theories of behavioral finance. So first we'll discuss about heuristics. So heuristics are referred as a rule of thumb which applies in decision making to reduce the cognitive resources to solve a problem. These are mental shortcuts that simplify the complex methods to make a judgment. Investor as decision maker confronts a set of choices which within certainty and limited ability to quantify results. This leads identification and understanding of heuristics that affect financial decision making. Some of the heuristics are representativeness, anchoring and adjustment, familiarity, overconfidence, mental accounting, availability. So this helps in making the decision. So basically, if there is a rule of thumb that this is going up, we have to buy, this is going down, maybe we have to sell. So if there is a thumb rule, then that is basically heuristics, which applies in decision making to reduce the cognitive resources to solve a problem. Basically, these are the mental shortcuts which we define for our own. That I have made up a mind. If I'll see this type of pattern, my mind will quickly say that this is going on. I won't do a much more detailed research for that topic. I'll see a certain thing, I'll make the decision. So this is kind of a shortcut for me. Second is framing. So the perception of choices that people have are strongly influenced by how these choices are framed. It means depend on how question is framed, even though the objective facts remain constant. So many a times that framing has also adversely affected people's choices. So basically the perception of choices that people have are strongly influenced by how these choices are framed. So I have a already predefined mindset and my decisions will be according to that only. Emotions. Emotions are and associated human unconscious needs, fantasies, maybe fears. So I'll take emotional decision that this is a stock, it is related to that particular company. And I believe that the owner of that particular company is a very good human being. So I don't care about the rational, which is about the fundamentals about that stock or something. My emotions are attached to that stock. So will be end up buying that stock. Or maybe I have bought a stock with me. The market suggests that it is a very good time to sell that stock, but I'm attached to that stock and I'm aiming it will go up. It will go much more up in future. So my emotions are attached to that thing, and hence my decision making is affected by that uh, emotions. The last characteristics of behavioral finance is market impact on the market. So um, do the cognitive errors and biases of individuals and groups of people affect market and market prices. Indeed. So the cognitive errors and biases of individuals and people particularly affect the market and market prices. Main attraction of behavioral finance field is that market prices did not appear to be fair. Firstly, we feel that these are not, this is not fair, which if I see something at once. So now there are few questions that how market anomalies fed an interest in the possibility that they could be explained by psychology. So standard finance argues that investors' mistakes would not affect market prices because when prices deviate from fundamental value, rational investor would exploit the mispricing for their own profit. But who are those who keep the market efficient? Even institutional investors exhibits the inefficiency. This prevents rational investor maybe from correcting price deviations from fundamental value. This leaves open the possibility that correlated cognitive errors maybe of investor could affect the market prices. So behavioral finance basically is not, it is not just a part of the finance. It is something which is much broader, which is much wider, which is can be discussed more in depth, and it also includes the insights from behavioral economics, psychology, and microeconomic theory. The main theme of traditional finance is to avoid all the possible effects of individual personality and mindset, but at the same time, behavioral finance is more uh, mainly dependent on that thing, that how the emotions play a role in making the decisions. Now we'll discuss about the objectives of understanding behavioral finance. So the main objectives are helps it helps in the decision making. The second objective is it helps me the identification of the errors.